Hey guys, and welcome back to Mike and his whiteboard. My name is Mike. This is my whiteboard. I hope you had a great holiday weekend. We are back for number of occurrences today. Now, if you're new to the show, basically this is a show where we construct concepts visually. So if you're having a hard time understanding things like extrinsic value, intrinsic value, volatility, anything at all, shoot me an email at support@dough.com and I'll try and construct that visually. If we have covered it before, you can check it out on Find Shows. So click on Find Shows at the top of. You can scroll down to Mike and his whiteboard and all of the shows are archived there. So today we're going to get into number of occurrences, and this is probably one of the most crucial concepts in my opinion for sustainable success, and that's because we always want to make sure that we're getting our number of occurrences high to realize our expected probabilities here. So I always like to think about this as like bankroll management. So before I started learning how to trade, I knew how to play poker, and I used to play poker a ton. And I understood the concept of bankroll management, which is basically keeping your size small, so not going to the table with all of your money at once, and basically picking your spots, picking high probability spots, but being sure not to go all in at once in any particular situation. So this is basically what number of occurrences is for trading. So when we say trade small, trade often, we're talking about keeping number of occurrences high and keeping percentage of portfolio low. So we like to keep it around 5% or less. That kind of gives us the good range of variance. So if we have a bad week or a bad month, then if we're trading small enough to withstand that, then we'll be okay in the long run. So let's look at number of occurrences, and we'll kind of plot this out with some plot graphs. So we always talk about standard deviation, how it looks kind of like a bell curve. What I like to imagine is basically putting a ton of plots, thousands of different plots on a graph, and based on standard deviation and probabilities, you're going to see that it kind of curls out over to a bell curve. So we're going to look at it like that, but in a different way here. So let's take a look at selling a one standard deviation put, which is basically 84% out of the money. So we covered this on an Ask YouTube, but when you're looking at standard deviation, if you are looking at out of the money options, if you have a 16% probability of being in the money, then you have an 84% probability of being out of the money. And basically you can always calculate that. If you just take 100% and subtract any in the money percentage, you'll get the out of the money percentage, and vice versa. So if I have 84% out of the money, I know that I've got a 16% in the money percentage here. So let's take a look at number of occurrences, and we're going to throw on 5 occurrences. So let's say over the course of 5 months, I sold a one standard deviation put 84% of the money, and I let it expire. So I didn't manage it at all. This is just looking at expiration. So out of these 5 occurrences, I've got 5 that expired out of the money. So right now I'm at a win rate of 100%. Now, why is this important? This is important because we've only got 5 occurrences, and since we're playing a probability game and this is a pretty high probability trade, it's very possible that it could go either way completely. So in this case, we've got 5 trades that are completely out of the money, so they were all winners. But it could have very well had 5 in the money options or 5 losers right away, which is why it's really important to keep our size small. Because if I'm using 25% of my whole portfolio and I've got in the money trades that are going against me, then I might be wiped out, and that's not what I want. So again, when I've got these occurrences low, we can see the variance in the probabilities that are the true out of the money percentages. Now, let's see what happens when we get some more occurrences on the board. So I had 5 good months of selling puts, but now let's say I went 1 for 5 in the next 5 occurrences. So now I've got 10 occurrences here. I've got 6 that expired out of the money and 4 that were in the money. So basically, I just went 1 for 4 in that scenario. So I won 1, lost 4. So again, if I'm trading too large for my particular account, then this could have been very bad for me in the long run. So again, we're always wanting to stay small and trade less than 5% of our total portfolio. So just to give you an example, if I've got a $100,000 account, when I'm looking at the buying power reduction for the initial trade, I'm looking for that to be less than $5,000. So we've got 10 occurrences here. You can see that the very first 5 occurrences, we were perfect winners. We got 100%. All of those were out of the money, but now we started to have a little bit of a bad few months. So now we're basically 6-4, which gives us a true out of the money percentage of 60%. Now let's see what happens when we jack this up even more. So we've got 100 occurrences now, and we're getting closer to our realized percentage. So basically, when we're talking about probabilities, the more occurrences we have, or the more dots we have on this screen, theoretically, the closer I'm going to get to that 84%, which is what I should be expecting. So you can see now I've jumped from 60% to 77%, and this is all arbitrary. This is just an arbitrary number, but I wanted to show you that the more occurrences that we have, the closer we may get to realizing that expected probability. So now we've got a ton of winners. We still had some losers that were in the money, but overall, if I'm trading small, I'm going to probably see a steep curve that's just gradually grinding up instead of something very volatile if I'm using a lot of basically the percentage of my portfolio. So last but not least, let's get 1,000 occurrences on here. And this is really where the true meaning of number of occurrences can shine through. So now we've got 83% true probability of being out of the money. So we're very, very close to what we should be expecting. And you can see based on just the density of those winners, if I'm trading small and just doing this over and over and over again, I'm going to realize that probability of profit or probability of being out of the money. And that's going to be a good thing for my account. Now, let's say we went all the way back to the beginning and I realized half of these right away. So I had a terrible year or a terrible few months. If I'm not managing the size of my portfolio, I probably would have blown out the account, which is terrible. I don't want that. So what I want to do is just make sure that I'm trading very small, trading often, just to make sure that I can withstand this variance or basically anything that might go wrong when we're dealing with probabilities here. But as you can see, if I've got a huge number of occurrences, trading small and trading often, I'm going to see a ton of out-of-the-money trades, which are going to be winners. Now, what's very interesting about this is that you can see that these true out-of-the-money percentages vary quite a bit. What happens if I were to manage my trades at 50% winners? Basically, you're going to see all of these go up. And that's because if I'm not holding a trade till expiration, if I reach 50% probability of profit, which you might hear on the Taste Trade Network all the time, and I'm taking that trade off, basically I'm removing the risk from the trade. So let's say I was risking one to make one. If I'm risking one to make one and I reach 50% of profit, now basically I only have 0.5 left to make and 1.5 left to lose. So if I'm risking one to make one and I've got half of that profit, again, if I have 1 and I make half of one that I'm trying to make, I only have half of that now that I can be profitable in the future. And I'm risking the gain that I've made, and that now goes into the loss column. So when I'm taking off the trade and capturing that profit, my probability of being out of the money or being profitable in whatever situation I'm trying to play is going to be much higher. So let's look at some takeaways here. So the first takeaway is that obtaining a large number of occurrences is crucial to realizing expected probabilities. Now, we saw this with the first few examples. The first 5 occurrences, I was 5 for 5, which was perfect, but it could have gone the other way just as equally. And in the second occurrence, we kind of took a downturn. We had a bad few months, and we were 60-40. So you can see that when you're just starting out or we have a few occurrences and we're not maximizing our occurrences, the probabilities can be skewed in either direction pretty drastically. The second takeaway is too few occurrences can result in very skewed results. So again, when I don't have enough occurrences to help me realize my expected probabilities, I could be skewed in a positive way or a negative way. It really all depends on the situation. It's going to be very random. So we always want to just trade small, make sure that we're not getting in over our heads and putting ourselves in bad situations, and just making sure we're getting as many non-correlated occurrences as we can. And appropriate position sizing is paramount, and I reference bankroll management here because I always like to think about it from a poker perspective, because that's what I knew before I even started trading. I knew how to manage a bankroll playing poker, so this is how I think about it in the same way. So as long as I'm not trading too much of my account or taking all of my money to that one table and risking it all, I know that if I keep my size small, even if something major happens, then if my size is small enough, it shouldn't affect me. And last but not least, no more than 5% of portfolio per position with high probability trades. So this is kind of the trade small, trade often mantra. So when I have two of these things working for me, so if I've got my number of occurrences up and I'm trading small relative to my portfolio, when I combine these two things, I've got synergy in trading and I've got both of these things working for me, and basically I've got non-correlated occurrences. I'm realizing my expected probabilities quicker, and if I'm managing my positions, I'm even realizing a higher probability of profit. So I'm increasing that number and I'm doing everything that I need to do to be successful in trading. So this has been number of occurrences. If you've got any feedback at all, shoot us an email at support, or you can tweet us at Mike. Thanks so much for watching, and be sure to tune in tomorrow. We're going to start getting into Greeks. So tomorrow we're talking about delta, then we're going to talk about gamma and theta. So if you have any hard time understanding those three things, we're going to break it out and just break them down completely for you, and hopefully you'll like it. So thanks again for tuning in. My name is Mike, and this has been Mike and his whiteboard.
What's up, YouTube? Thanks for watching our video.
If you like this video, give it a thumbs up.
Click below to watch more videos, subscribe to our channel, or go live to... F*** that. Sorry.